Hey everybody, we're going to talk about business financing and how it works and everything that goes into it and how it differs from consumer financing. Because a lot of contractors will ask us, what do I need to bring to the table to do a loan or any kind of business financing, how it differs from doing something on my personal side of things, and how long it takes, and then what other processes are involved. So in the very beginning, you need to make sure you actually have a business. So you can't do business financing without an actual business entity. So if you don't have a business, if this is something you're brand new to, make sure you talk to an accountant or an attorney or somebody that can register a business for you, whether it's an LLC or an S Corp or a C Corp, or whatever it's going to be. Get that business entity structure in place first. Once you have that documentation, then you need a banking account, checking account, maybe two checking accounts. But you definitely need a business and a business banking account. You cannot use a personal account. It needs to be linked to the business. Now that you have those very basic pieces of a business, now you can apply for business financing. So if you're brand new in business, it's going to be a lot more challenging to get approved for a business loan, especially if you're like a month or two in. If you have really good personal credit, you can do what's called a personal guarantee. And what that does is your business still gets looked at, you get analyzed as a business, but from a risk factor for the bank, if you're backing it with your personal side of things, like your actual home or your car, your personal credit, whatever you have on the personal side of things, you link those together, you're basically co-signing your own loan. You've got the business loan, but you're co-signing it with a personal guarantee. As a brand new business, that's normal, and it's probably going to be required. Even if you have amazing credit, you're still going to have to do that because banks don't like brand new businesses because you don't even know what the risk factor is. There's just too much going on. They don't know if it's going to go out of business in 3 months or if it's going to do really well in 3 months. So that's the very basics. So maybe let's fast forward to 2 years. If you're at that 2-year anniversary for your business, yes, there's lower risk because you've been in business now for 2 years, but the bank is still going to look at anything that's 2 years or younger as high risk when it comes to business financing. If you've passed your 2-year mark, that's kind of that threshold where the banks like you a lot more. Just because you've exceeded 2 years in business, you may or may not need to do a personal guarantee, but if you're less than 2 years in business, just expect that you're probably going to have to do a personal guarantee. They're going to look at your business credit, they're going to look at your personal credit. Now, everybody knows that to get your personal credit, you provide your social security number, and then they look up your personal credit report. The way the business credit report works is you have what's called a Dun & Bradstreet number, or a D&B number. If you don't know what that is, go on the Dun & Bradstreet website, and you can either create an account or just search for your business, and you'll get that number. That's how lenders or even creditors or other businesses will analyze your credit to see what kind of business you are. Your personal information won't be on there, but the business information will. Now, the interesting thing about the D&B is it's not always 100% accurate as far as what's on there because it's not a formal credit reporting agency. It has vague information based on what people are providing it, but it doesn't mean it's always 100% accurate. So what I do recommend is if you don't have an account with the Dun & Bradstreet, set one up. You can even pay for an annual subscription, and then you can actually upload your financials. That way you know that the Dun & Bradstreet information is accurate with your actual business information as far as your monthly income, your annual income, how many employees you have, your address. Make sure all that is accurate, and you can even do that for free. You don't need a subscription to do that. But get all that information on the D&B website so that way anyone checking your business credit, they're seeing realistic numbers as far as your income. Now, of course, what you're owing other creditors, that's a different story. You don't have any control over that. That's based on what people are reporting to D&B. But the bank who's going to lend to you is going to look at all that information, and they're also going to look at your personal information if you have to do a personal guarantee. Now, people think that if you're going to do an LLC, that's going to limit your liability as a company to your personal assets. Yes, that's correct. However, if you're doing a personal guarantee, that's kind of dropping that veil, dropping that barrier, because the bank wants to limit their risk by having you personally back up that business loan. So say your business goes out of business and you no longer make payments on the equipment you're purchasing. That personal guarantee kind of breaks that barrier so that they can actually come after your personal assets. So just make sure you keep paying your bills, and then you won't have any issues. Now, the great thing about the business financing is even if you do a personal guarantee, it doesn't mean it's going to report that to your personal credit report. If you are making your payments on time and everything's going well with that business loan, then nothing even really shows up in most cases on your personal credit account. Now, say you've been in business for maybe 10 years, 20 years, 45 years. Does that mean you do not need to do a personal guarantee? Well, technically no, because it depends on how that business is performing. The lender may or may not require it. If the business is kind of at risk or it's kind of up and down and all around, they're not really sure, they may just say, hey, do a personal guarantee or co-sign it just for kicks. We're going to be much happier. Or maybe they're going to approve it at a certain rate without the personal guarantee. But if you add your personal guarantee, they're going to lower the rate because now there's less risk from their perspective. So if you do a personal guarantee, it's good. I would highly recommend it because it'll keep your cost of doing business down. So how long do you want to do your business loan for? Is there a perfect answer? Not really. It's based on your situation, your business situation, the income you're generating, how young you are, how old you are, not as a person, but in your business. So maybe you're a brand new business getting started. You want to reserve as much cash as possible. You want your loan payment to be as small as possible. Just know that you're going to have a much longer loan term to make a smaller loan payment. Also know that the longer the term, the more you're going to pay in interest or finance charges. Why? Because it's more risk to the bank. They have to make money as a profit, as a business, as a bank, but they also need to make more profit because there's more risk when there is more risk, because there's always going to be people who don't pay. So as long as you pay on time, that's what keeps your credit risk much lower. They can give you better rates, but they still have to have income to support that risk that's involved, even though if it's very small risk. So if you want a small loan payment every month and you want it for a longer term, just know you may pay more over the entire length of that term. So let's just pull an example. Maybe you're buying some equipment for $20,000. If you pay cash, you're paying 20 grand, it's paid off, great, you've got it. But now you don't have that 20 grand sitting in your bank account. Well, maybe you want to keep that 20 grand sitting in your bank account, so that's why we're here talking about a loan. If you're comfortable with $400 a month based on your monthly cash flow and the amount of money that's coming in, $400 a month, and say that's a 60-month term or maybe a 48-month term. Just for the sake of the analogy, $20,000 equipment, $400 a month, maybe that's going to cost you $23,000 by the end of that loan, by the time it's all paid off. Okay, I think $3,000 in interest or finance charges is fair for borrowing $20,000 over the course of 48 months. Totally fair because the bank's got to make money too. Just like you in business, you have to make money too and take food home or take money home to put food on the table for your family. Now, maybe we change the risk factor. Maybe you're higher risk or you want to make a longer loan or something like that. And your proposal from the lender is going to add up to be about $26,000. $6,000, 30% of the actual equipment. Does that sound a bit much? Yeah, but again, remember you've now got that $20,000 still in your checking account to play with as cash flow for your business. So does that mean paying $800 a month is a bad thing? Well, not necessarily, because if that $800 a month payment is generating $40,000 to $50,000 of income for the month, looking at that cash flow and the amount of profit, you're still coming out on top, because without that payment, you couldn't do it. So do you want to pay $40,000 for a $20,000 machine? Well, no, that might be getting a little bit extreme. But even if it was, maybe you just have really bad credit and you're trying to restore that credit, you may have to pay $1,000 a month for that equipment. And as long as you stay on top of it, that's because of the risk factor involved. But at least now you've got that equipment, you're paying $1,000 a month out for that equipment, but you're still generating $40,000 to $50,000 of income per month from that equipment that you're paying out. So you're still making profit, you still got positive cash flow, it's still worth it. The mistake that a lot of people make is that when you're looking at just the sum of the payments, that's all you're focused on, and you're not looking at all the business numbers that go into it as far as what this can do. So if this was a loan for a personal car, maybe you just want to get a sports car for fun or a motorcycle or something like that, that would be a bad idea. I would not recommend taking out a loan for something that's going to be double its value. Now, a house is a different story. That's an investment for your family. But as far as just something that's fun, like a car for entertainment, for example, I would not recommend a loan that's going to double in value. But for your business investment that's going to make you more money, absolutely. I mean, even for your house, for your mortgage, think about it. If you're going to pay a bank for a mortgage, even if it's at 3% interest over the course of 30 years, maybe you're getting a house for 200 grand, but at the end of that mortgage payments, you're paying 400 grand. Well, in 30 years, that home was probably still worth more than 400 grand. So you still made more money. It's still an investment. You still have positive cash flow, positive profit from that investment. So same thing from your business. If that equipment with that monthly payment, no matter what it is, as long as you have positive cash flow and positive profit, you're good. It's still worth it. But you do still want to minimize it. You want the best deal. You want to make the most profit and maximize all that. So that's where you can pull in all these different analogies. Another note to make about business financing is the way the bank makes money is not always going to be with an APR interest rate. So if you think about your personal mortgage or a credit card, those have an APR interest rate involved. you're paying a percentage of the average daily balance to that APR interest. Your business financing works a little bit different. Most of the time when it comes to equipment purchases, your term of that agreement is basically paying the lender for the equipment. The lender still owns that. It's like a lease to own instead of a loan. And then the finance charges are just that. It's a fixed finance charge. When you make your last payment, then that ownership of the equipment technically transfers to you. If you default on the loan, the lender will actually repossess that equipment, of course, if you just completely stop paying. So when you're making all your payments, the last payment, you are basically paying that off and now it's yours. Or if they give you an early buyout option or you just pay it off early, you're not really saving any interest. You're not really saving on any finance charge. You're just getting rid of that payment. You no longer have that monthly outflow of cash and you own it in full and you don't have to worry about it anymore. So it is nice to pay off early. However, if you want to maintain lots of positive cash flow, if things are running a little bit tight, I would recommend just keeping your loan as is. Don't pay it off early. Just let it run, through its course. Because say you're buying that $20,000 equipment and the sum of the payments are $23,000, that $3,000 difference is just a fixed finance charge. It's not like it's a pre-calculated interest rate, because if you pay it off early, you're not going to save on any of that $3,000. You're still going to pay it all. They're still going to require you to, pay that full 23 grand by paying it off early, but at least there's no additional charges, or at least there's no additional charges on top of that. So just to kind of clarify a little bit difference between APR interest rates and finance charges, most business loans work off of a fixed rate finance charge, and that's just to cover their cost of doing all the paperwork, kind of like the underwriting process. Think of it kind of like the closing costs when you buy a house. All that money has to pay attorneys, the bank, the risk factor, everything that's involved. That way it's just a fixed finance charge. That also keeps things low for you, because if it was just a random interest rate, that could kind of get out of hand. If you were going to do that, just use a credit card. But that's going to be like 16% interest. You don't want to do that. So keep it tight, keep it concise, and just stick with the finance charge of business lending. And it's super easy. The application process is fast. So when you're looking at the offers, so you submit an application to the bank and they analyze your business credit. They ask for a personal guarantee and you provide all that. Great. Now, the way it works with us, with Quipt and Approved, that's the lender we use. Actually, that's the broker we use. They work with 13 lenders. That's going to maximize the approval rate from the lenders, because they're kind of competing against each other to get your business. But it's also going to keep the finance charges low, because they know that you're going to be looking at the price, the value that you're going to be paying out. So whoever has the best offer is who you're going to pick. So let's say, for example, 3 lenders approve you, and each lender gives you 3 options for payment options. You can go in there and pick your lender and pick your payment option. And then from there, it just goes to contract. I provide an invoice and I get paid. We ship the equipment to you, and that's it. So it's a really, really simple process. Once you submit your application to receiving signed contracts, that's usually about 3 days. And then you get your equipment rather quickly. So hopefully that answers all the questions that you may have about business financing and everything that goes into it, what you might need, and kind of looking at some more of the numbers as far as not just focusing on the sum of the payments and the finance charges or the interest, but also looking at, just the positive cash flow and the profit that that's going to generate. So that's business financing kind of in a nutshell. If you have any questions about your actual application that you have in with us, or maybe you're about to do an application and you want to reach out with any additional questions you have, we're happy to answer. You can talk to myself or any of the staff here at Clean Pro Supply Resin Force Products, and we're happy to help. Take care.